Welcome back to Investing Talk Podcast. Have you been keeping an eye on American Airlines?
Oh, yeah.
The stock ticker symbol, AAL,
Yeah.
has been on a bit of a roller coaster ride lately.
For sure.
And we're going to break down exactly why that is and what it might mean for you if you're thinking about adding it to your portfolio.
AAL is a fascinating case study right now. There are some strong positive signals, but also some potential headwinds that investors need to be aware of. It's a classic example of a company at a crossroads.
I like that, a company at a crossroads.
hmm
So to set the stage for our listeners, can you walk us through some of the recent price action that's got everyone talking?
Absolutely. Let's rewind to January when AAL announced their Q4 2024 earnings. They actually exceeded analysts' expectations, pulling in record revenue and free cash flow. But then just a few weeks later, they released their Q1 2025 guidance, which was much weaker than anticipated, and that sent the stock tumbling down to $15.23. Since then, it's been bouncing around between $15 and $17, caught in a tug of war between those who believe it's a buying opportunity and those who are more cautious.
Okay, so we have a classic buy the dip scenario playing out here. But before we jump into the whole buy, sell, or hold debate, let's unpack what's really driving this volatility. What are some of the key factors at play?
Well, on the technical side, we can see that AAL is currently trading between its 50-day and 200-day moving averages. Now, for those who might not be familiar with these indicators, the 50-day moving average is basically the average closing price of the stock over the past 50 days, and the 200-day is the same, but over 200 days. Traders use these averages to identify trends and potential support or resistance levels. In AAL's case, the 50-day average is around $17.32, acting as a ceiling, while the 200-day average sitting at $14.50 is acting as a floor. This kind of tight range often suggests that the stock is consolidating, and a breakout in either direction could signal the next major move.
That's really helpful context, especially for our listeners who might be newer to technical analysis. So it sounds like from a technical perspective, AAL is giving us mixed signals, which explains the current wait-and-see approach you mentioned earlier. But what about the fundamental picture? What's happening within the company itself and in the broader industry that might be contributing to this uncertainty?
You're right. The fundamentals are crucial here, and there are definitely some bright spots for AL. They wrapped up 2024 on a high note with impressive revenue and free cash flow numbers. Plus, they secured a 10-year deal with Citi for their co-branded credit card, which is set to kick in 2026. Some analysts are even suggesting that AAL is undervalued right now, pointing to its low price-to-cash flow ratio compared to other airlines.
That Citi deal is a big one. A 10-year agreement provides a lot of stability and predictability for their loyalty program revenue stream. It seems like they're making a strategic push towards those higher margin segments.
Exactly, and that's a smart move in the current environment. But we also need to consider the factors that are weighing on ALL's performance. There were a couple of safety incidents in February involving bomb threats on flights. While these turned out to be false alarms, they can still shake investor confidence and impact consumer sentiment.
That's true. Even the perception of risk can have a real impact on an airline's bottom line. And then, of course, there are the broader economic factors that are creating headwinds for the entire airline industry.
Right. Goldman Sachs has been talking about potential tariffs on goods from Mexico, Canada, and China. Now, if those tariffs are implemented, it could significantly impact AAL's international routes, adding to their operational costs and potentially squeezing their profit margins.
And we can't forget that weaker than expected Q1 2025 guidance. Even with a record year in 2024, that guidance really spooked the market. What do you think is driving that weaker outlook?
Well, remember that the stock market is always forward-looking. Investors are more concerned with future earnings potential than past performance. It seems that AAL is anticipating some challenges in the first quarter of 2025, and that's creating uncertainty even in the face of their strong 2024 results. It highlights the fact that the airline industry is cyclical and susceptible to various economic and geopolitical factors.
It's a good reminder that past performance is not necessarily indicative of future results, especially in a volatile industry like airlines. But before we get too deep into the weeds on those macroeconomic factors, I want to go back to the idea of AAL being potentially undervalued. You mentioned their price-to-cash flow ratio. Can you explain what that means for listeners who might not be familiar with that metric and why it's important in this case?
Sure. The price to cash flow ratio, or PCF ratio, is a valuation metric that compares a company's market capitalization to its operating cash flow. It essentially tells you how much investors are willing to pay for each dollar of cash flow generated by the business. A lower PCF ratio can suggest that a stock is undervalued relative to its cash generating ability. And in AL's case, their PCF ratio is lower than the industry average, which is why some analysts see it as a potential bargain.
Okay, so we have a situation where AAL is showing some signs of being undervalued based on certain metrics, but there's also this cloud of uncertainty hanging over them due to external factors and their own guidance. And this is where the comparison to United Airlines becomes really interesting, right? United stock soared almost 190% last year, while AL's gains were a much more modest 37%. What can we learn from that contrast?
It's a stark difference, and it suggests that AL hasn't been able to capitalize on the industry's recovery as effectively as United. United has been very strategic in capturing market share and optimizing their operations. They've also been more successful in managing investor expectations. ALL, on the other hand, seems to be struggling to convince the market that they can keep pace with the competition. It makes you wonder if there are underlying issues that aren't reflected in the current valuation.
Right. So how do we reconcile those seemingly conflicting narratives, the potential value play versus the concerns about their ability to compete? One thing that caught my eye in their earnings report was the growth in their premium and loyalty revenue. Premium revenue was up 8% year over year, and loyalty revenues from things like co-branded credit cards surged 14%. It seems like they're strategically shifting towards those higher margin segments, which could be a key driver of future profitability.
That's a very astute observation, and it's a trend we're seeing across the airline industry. United Airlines, for instance, saw a 10% increase in premium revenue. Passengers are increasingly willing to pay a premium for more legroom, better seats, and other perks. And those loyalty programs, especially the co-branded credit cards, generate a significant amount of revenue for airlines.
And that new city deal should give AAL a nice boost in that area. But how does this focus on premium offerings play into the competitive landscape? You mentioned that Delta has a pretty attractive valuation right now with a low forward price-to-sales ratio, and Alaska Air just acquired Hawaiian Airlines, which points to a trend of consolidation in the industry.
Yeah.
How does AAL stack up against these larger players?
That's the million-dollar question, isn't it? Delta is a powerhouse in the industry, known for its operational efficiency and strong customer loyalty. Their low forward price-to-sales ratio, which basically compares their current market value to their expected sales over the next 12 months, suggests that investors are confident in their future growth prospects. And the Alaska-Hawaiian merger creates a formidable competitor on the West Coast, potentially putting pressure on AEL's market share in that region. Yeah. Consolidation in the airline industry can be a double-edged sword. While it can lead to cost savings and increased efficiency, it can also make it more difficult for smaller airlines to compete.
So if we're putting on our analyst hats here, what are some of the key factors that investors should be watching closely when it comes to AAL's competitive positioning?
I would say there are three key things to keep an eye on. First, how effectively is AAL executing its strategy to grow its premium and loyalty revenue? Are they investing in the right products and services to attract high-value customers? Second, how are they managing their costs in the face of rising fuel prices and other inflationary pressures? And third, how are they navigating the increasingly competitive landscape, particularly with the threat of consolidation? Their ability to answer these questions successfully will determine their long-term success.
Okay, so let's bring it all back to the question that's on everyone's mind. Is AAL a good investment right now? We've laid out the bullish case. They had a record year in 2024. They have this promising city deal. They're making strategic moves to boost profitability, and some analysts believe they're undervalued. But then there's the bear case, the weaker Q1 2025 guidance, those safety incidents, the potential tariffs, and the competitive pressure from larger rivals like Delta and United. So where do you land on this?
It's a tough call, and there's no easy answer. It really depends on your individual investment goals and risk tolerance. If you're a value investor who's willing to ride out some near-term volatility, AAL might be worth a look. Their current valuation does present a potential buying opportunity, and if they can execute their strategy effectively, there's certainly room for upside. The average analyst price target for what it's worth is $20.24, implying nearly 15% upside.
But for investors who are more risk-averse, it might be prudent to stay on the sidelines for now and see how things play out.
Exactly. The airline industry is notoriously cyclical and sensitive to economic shocks. There are a lot of moving parts here, and it's important to weigh both the potential rewards and the risks before making any decisions. If AAL's stock breaks through that $17 to $18 resistance level we talked about earlier, that could be a bullish signal, but a drop below $14 could signal further downside.
And that projected Q1 loss could add to the near-term volatility.
Precisely. This is a stock that requires close monitoring and a good understanding of the airline industry dynamics.
So to wrap up our discussion on American Airlines, ticker symbol AAL, it seems like the key takeaway here is that it's a stock with a lot of potential, but also a fair amount of risk. It's a classic example of a stock that requires investors to do their due diligence and really understand the company, the industry, and their own personal risk tolerance.
I completely agree. It's not a stock for the faint of heart, but it's certainly one that could offer significant rewards if things go their way.
So for our listeners who are maybe intrigued by AAL, but not quite ready to pull the trigger, what are some key things they should be watching for in the coming months to help them make a more informed decision?
I would say keep a close eye on their earnings reports. Pay attention to their revenue growth, especially in those premium and loyalty segments. See if they can maintain that momentum and if they're making progress on their cost-cutting initiatives. Also, watch for any news regarding those potential tariffs and how AL is planning to mitigate any negative impacts.
And don't forget to keep an eye on the competition. How are Delta and United performing? Are they gaining market share at AL expense, or is there room for everyone to grow in this post-pandemic travel boom?
Yeah. Those are all excellent points. And I would add one more thing. Watch for any signs of innovation. Are they investing in new technologies or partnerships that could give them a competitive edge? Are they adapting to the changing needs and preferences of travelers? The airline industry is constantly evolving, and those who can stay ahead of the curve will be the ones who thrive.
So it's a dynamic industry with a lot of moving pieces, which is why we love talking about it on Investing Talk podcast. It's always a fascinating case study.
It certainly is. And AAL is a perfect example of a company that's both intriguing and a bit of an enigma. It's a company with a rich history and a strong brand, but it's also facing some significant challenges in a rapidly changing environment.
Well said. I think we've given our listeners a lot to think about today. A&L is a stock that's definitely worth keeping on your radar. But as with any investment, it's crucial to do your homework, understand the risks, and make decisions that align with your individual financial goals.
And never invest more than you can afford to lose. That's rule number one in investing.
Absolutely. Couldn't agree more. Well, I think that about wraps up our discussion on American Airlines, ticker symbol AAL. It's been a great conversation, and I always appreciate your insights.
The pleasure is all mine. I always enjoy our discussions.
And we enjoy having you on Investing Talk podcast. To our listeners, thanks for tuning in. We hope you found this analysis informative and insightful. As always, we encourage you to subscribe to our channel, share this episode with your fellow investors, and leave us a comment below with your thoughts on AAL or any of the stocks you'd like us to cover in the future. Until next time, happy investing.